Yeah, I mean, if we're looking at a wholesale basis, our buying criteria is really what the cash buyers or what the investment buyers want in our market, right? So if we go to in St. Louis, there are certain areas where it's just high rental market, there's not a whole lot of rehab and flips. Cool. Well, then most of the time in those markets, investors want at least 3 bedrooms. Ideally, they want 2 full bath or better, and they're willing to pay at a certain price point based on rental income. You know, the 1% rule was always the case. If it's a little bit nicer area, kind of within that rental area, it might drop down to 0.9 or 0.8% rule, meaning that the rent for 1 month is, on a 1% rule, the rent for 1 month is 1% of the all-in cost of that property for that investor. So if they think they can get $1,000 a month in rent, then they can't be all in for more than $100,000. If the area is a little bit nicer and maybe the price point is $200,000 and that's where they're gonna be all in at, maybe they drop down and they go to the 0.8% rule because it's a nicer area and there's gonna be more appreciation and the value of that home is gonna be kind of see some exponential growth into the future because they can't build new homes at that price point and there's more demand in that area. Well, they might take a little bit less in rent knowing that the valuation of that home is gonna go up depending on their investment criteria. So really that's kind of how it's evaluated from our standpoint.